The financial world is built on a lie sustained for 54 years by geopolitical might and printing presses. We are talking about the US dollar, the world's reserve currency, backed by nothing but faith and debt. But faith is eroding, and the debt spiral has become a death spiral. In March 2023, President Donald Trump uttered words that were largely ignored by the mainstream media, but carried the weight of history for those who understand monetary cycles. He said, and I quote, "We used to have a thing called the gold standard. It was beautiful. We had real money. Now we have paper backed by nothing. That will change." Then, in July 2024, he followed up with a direct campaign promise. "On day one, I will restore sound money to America. The dollar will be strong again, backed by something real." Most analysts dismiss this as mere political rhetoric. They are wrong. This is not a campaign promise. This is a battle plan. A national security preemptive strike against the most serious monetary threat the United States has faced since 1971. The target date for this financial maneuver is not random. It is 2027. This is not a conspiracy theory. It is a historical pattern. Currency resets happen when debt becomes unpayable. We are now 54 years past the last major reset. The Nixon shock, and the US federal debt stands at over $36 trillion. Trump is preparing to do something that will revalue gold by 10 to 20 times its current price. It will wipe out trillions of dollars in paper debt and fundamentally shift global economic power. This is the largest wealth transfer in human history. Those holding paper assets will lose 90% of their real purchasing power, while those holding physical gold and hard assets will become unimaginably wealthy overnight. This video will show you the exact 5-step mechanism Trump will use, the historical precedents that guarantee its success, and why 2027 is the most likely year the dollar as we know it will end. This is not speculation. This is pattern recognition. The timeline is set. The preparation is underway. To understand the reset that is coming, you must first understand the resets that have already happened. This is not unprecedented policy. It is the historical playbook. We are focusing on two critical dates, 1933 and 1971. The classical gold standard, 1879 to 1933. From 1879 until 1933, the United States operated on a classical gold standard. This system was elegantly simple and fundamentally honest. Every US dollar was redeemable for a fixed amount of gold at $20.67 per ounce. The gold standard served as the ultimate financial restraint on government spending. It meant that the government could not print more dollars than it held gold to back them. This discipline prevented unchecked inflation and the kind of massive deficit spending that plagues us today. It guaranteed that the US dollar held real, measurable value. The original confiscation, 1933. The system ended not because it failed, but because it succeeded too well at restraining the government. By 1933, the Great Depression demanded that President Franklin D. Roosevelt inflate the money supply to inject liquidity and stimulate the broken economy. He could not do this while the dollar was legally tied to gold. The solution was brutal and swift. On April 5th, 1933, Roosevelt issued Executive Order 6102. This order made it a criminal offense for American citizens to own, hoard, or fail to surrender gold coins, gold bullion, and gold certificates to the Federal Reserve. The penalty for non-compliance was a $10,000 fine and up to 10 years in prison. Millions of Americans were required to turn in their private property, their life savings, to the government at the pre-existing, non-inflated price of $20.67 per ounce. This was outright confiscation. Once the government had seized the gold, they performed the reset. In 1934, the Gold Reserve Act officially revalued the gold price to $35 per ounce. This single stroke of the pen devalued the dollar by 69% overnight. Americans who had obediently surrendered their gold at $20.67 watched the government immediately revalue that same gold to $35. The government effectively expropriated over $3 billion in wealth from its own citizens. The goal was achieved, the dollar was devalued, and the government could now print more currency against its newly revalued gold holdings. Bretton Woods and the Nixon shock, 1944 to 1971. After this reset, the world operated under the Bretton Woods system. The dollar was still tied to gold at $35 per ounce. But crucially, only foreign governments could redeem dollars for gold. American citizens remained locked out. This system cemented the dollar's status as the world's reserve currency. But the US government could not resist the printing press. By 1971, foreign governments held over $70 billion in dollar claims, while the US Treasury only held about $10 billion in gold reserves. The system was mathematically unsustainable. Foreign countries, led by France, began demanding gold for their dollars. Gold flowed out of Fort Knox. On August 15, 1971, President Richard Nixon went on television and announced that the United States was unilaterally closing the gold window. The direct convertibility of the dollar to gold was severed forever. This is known as the Nixon shock. Since that day, the dollar has been a pure fiat currency, backed only by trust. The result has been catastrophic. The US money supply has increased by over 3,000%, and the dollar has lost 98% of its purchasing power. What cost $1 in 1971 costs nearly $7.50 today. The key takeaway is this: currency resets are not hypothetical, they are historical fact, and they always involve the revaluation of gold to inflate away unpayable debt. The fiat currency system established in 1971 depends on three fundamental pillars for its global dominance: global reserve currency status, the petrodollar system, and military enforcement. For 54 years, these pillars have held the dollar aloft, allowing the United States to print money and export its inflation. Today, all three pillars are visibly crumbling, making a monetary reset an economic necessity, not a political choice. Pillar 1. The decline of reserve status. The US dollar's share of global central bank reserves is rapidly shrinking. In 2000, the dollar accounted for approximately 71% of global reserves. As of 2024, that share has fallen significantly to just 58%. Why are nations fleeing the dollar? The primary reason is the weaponization of currency. In 2022, following the invasion of Ukraine, the United States and its allies froze $300 billion worth of Russian central bank reserves. While politically justified by some, this action sent a clear, chilling message to every sovereign nation holding US Treasury bonds. Dollars are not safe from political seizure. Countries like China, Saudi Arabia, and Brazil learned the lesson immediately. Dollar reserves are a liability, not an asset, if you ever fall out of favor with Washington, D.C. This realization fundamentally breaks the trust required for a global reserve currency. Pillar 2. The demise of the petrodollar. The petrodollar system, established in the 1970s, required that global oil, the lifeblood of the global economy, be priced and traded exclusively in US dollars. This created permanent, artificial demand for the dollar, regardless of US debt levels. This pillar is collapsing. In March 2023, Saudi Arabia, the cornerstone of the petrodollar, announced it would consider accepting the Chinese yuan for oil purchases. Furthermore, in December 2023, Saudi Arabia formally accepted an invitation to join the BRICS economic bloc. The BRICS nations, Brazil, Russia, India, China, and South Africa, now including Saudi Arabia, the UAE, Iran, Ethiopia, and Egypt, represent 45% of the global population and 36% of global GDP. They are actively discussing and developing a common gold-backed currency for international trade settlements, bypassing the dollar entirely. The death of the petrodollar is the death of the dollar's guaranteed global demand. Pillar 3. The debt-death spiral. The core of the domestic crisis is the debt. US federal debt currently stands at over $36 trillion, equivalent to over 120% of the country's gross domestic product. Even more alarming are the interest payments. The government is now spending nearly $1.2 trillion per year just to service the interest on this debt. This figure is now higher than the entire US defense budget. The government is borrowing money merely to pay the interest on previous borrowing. This is the definition of a debt-death spiral. This debt is unpayable in honest money. The only historical way out of this kind of sovereign debt crisis is through inflation, printing currency to pay back debts in devalued dollars. This is what the reset achieves. The greatest indicator: central bank gold rush. The most concrete evidence that the world's financial elite are preparing for a currency reset is the unprecedented pace of central bank gold accumulation. Since the Nixon shock, the last time a major monetary shift occurred, we have not seen this level of gold buying. In 2022, central banks bought 1,136 tons of gold. In 2023, they bought 1,037 tons. Over the past 3 years, central banks have accumulated over 3,000 tons of physical gold. Who is buying? Not the West. The purchasers are overwhelmingly the BRICS nations and those aligned with them: China, Russia, Turkey, India, and Poland. Russia has increased its reserves from approximately 600 tons in 2010 to over 2,300 tons by 2024. China officially reports holding over 2,264 tons, but most analysts estimate their true reserves are between 4,000 and 6,000 tons. These are not random purchases. This is strategic positioning for a global monetary shift. The countries preparing to issue a gold-backed currency are converting their vulnerable dollar reserves into the ultimate form of sound money. They are preparing for financial warfare, and Trump is moving to preempt them. The coming monetary reset will not be a gradual transition. It will be an abrupt, sudden action executed under the cover of national crisis. President Trump would not need to invent a new policy. He has a precise 5-step historical playbook established by Franklin D. Roosevelt in 1933. This mechanism is designed to achieve 2 objectives simultaneously: restore confidence in the dollar and inflate away $36 trillion in debt. Step 1. Declare a national emergency. The president cannot simply announce a return to a gold standard. Such a radical move requires immense legal authority. This authority is already written into law under the Trading with the Enemy Act of 1917 and the International Emergency Economic Powers Act of 1977. Roosevelt used these very statutes to justify Executive Order 6102. Trump's justification would be framed as a matter of national security. He would argue that the BRICS nations' impending gold-backed currency launch is an economic Pearl Harbor designed to destroy the US dollar and cripple America's standard of living. This framing makes political opposition virtually unpatriotic, clearing the path for swift executive action. The action would be sudden, perhaps over a 72-hour weekend window, or a banking holiday to prevent capital flight and panic. Step 2. Gold restriction or confiscation. For the dollar to be credibly backed by gold, the US government needs a much larger gold reserve, or it needs to revalue its existing gold much, much higher. The current official US gold reserve is approximately 8,330 tons. At the current market price of around $2,000 per ounce, this reserve is worth only about $520 billion. The total US money supply, M2, is roughly $21 trillion. The $520 billion in gold reserves is mathematically insufficient to back this currency supply, even partially. Following the 1933 precedent, the executive order would likely restrict private gold ownership. While total confiscation might be politically untenable today, a restriction is probable. Americans might be prohibited from holding more than a small amount of gold, perhaps 5 ounces per person, with anything exceeding that amount required to be surrendered to the Treasury at the current market price. This provides a crucial, rapid injection of physical gold into the National Reserve. Step 3. Revalue gold massively. This is the central event of the reset and the mechanism for the wealth transfer. After acquiring additional gold, the government announces the new fixed price of gold relative to the dollar. It will not be $2,000 per ounce. Let us examine the calculation based on the required backing. If the US government aims to back just 25% of the $21 trillion money supply with gold, it needs approximately $5.25 trillion worth of gold value. The 8,330 tons of gold the US holds is equivalent to 261 million ounces. If we divide $5.25 trillion by 261 million ounces, the math shows that the new fixed price of gold must be approximately $20,000 per ounce. The price of gold does not rise gradually. It jumps overnight. When the government announces the new fixed price of $10,000 or $20,000, gold holders see their assets instantly multiply in dollar terms by 5 times or 10 times. This is the greatest wealth transfer in history. Step 4. Restructure debt via devaluation. This is the hidden purpose of the reset. The US government owes $36 trillion, By devaluing the dollar by roughly 90% from the gold price, jumping from $2,000 to $20,000, the debt is effectively inflated away. Nominally, the government still owes $36 trillion. But that debt is now payable in dollars that are worth only 10% of their pre-reset purchasing power. In real terms, the $36 trillion liability is now economically equivalent to only $3.6 trillion in pre-reset value. The creditors, foreign nations, central banks, pension funds, and bondholders are paid back in full, but with severely devalued currency. This is a de facto default without the legal stigma of one. Step 5. Implement the new gold-backed dollar. After the confiscation, revaluation, and debt restructuring are complete, the government implements the new system, Bretton Woods 2.0. The dollar is now officially gold-backed at $20,000 per ounce, restoring confidence and credibility globally. However, redemption for gold is likely restricted to foreign central banks under strict conditions, and American citizens remain unable to exchange dollars for physical gold, mirroring the system from 1934 to 1971. This 5-step process could be executed in less than a year, with the final implementation targeted for the end of 2027. Why is 2027 the most probable date for this historical reset? It is not a random guess, it is the point where financial history, political capital, and geopolitical urgency converge. We see 5 distinct factors pointing directly to this single year. Factor 1. The 50-year monetary cycle. Monetary history shows that major currency resets occur in cycles, typically separated by 50 to 100 years, when debt and imbalance become structurally unmanageable. Asterisk. From the start of the classical gold standard in 1879 to Roosevelt's reset in 1933 is 54 years. Asterisk. From Roosevelt's reset in 1933 to the Nixon shock in 1971 is 38 years, an accelerated cycle due to the costs of the Vietnam War and Great Society programs. Asterisk. From the Nixon shock in 1971 to the projected date of 2027 is exactly 56 years. We are not merely due for a reset. Based on the average historical cycle, we are demonstrably overdue. The math suggests the system is operating on borrowed time. Factor 2. Political capital and the second term. Major controversial actions, especially those involving the forced confiscation or devaluation of wealth, require a president with maximum political leverage. Trump's second term, if he is elected, would run from January 2025 to January 2029. Historical precedent shows that the most controversial and audacious policies are implemented in the second or third year of a presidential term, before the distraction of the next election cycle begins. 2027 sits precisely in the middle of this window. For a second-term president who cannot run again, 2027 represents the year of maximum unilateral power to execute a financially necessary but politically painful policy. Factor 3. The BRICS deadline. The central geopolitical motivation for Trump's reset is the need to preempt the BRICS economic bloc. The BRICS alliance is actively working to launch its commodity and gold-backed common trade currency. Reports indicate that the BRICS currency could begin trials as early as 2025 or 2026. Trump must stabilize the US dollar or at least restore its credibility before the competing BRICS system gains critical mass adoption in international trade, particularly among oil-producing nations. If BRICS launches a credible, gold-backed currency first, the dollar faces an existential threat. The reset must happen in late 2026 or early 2027 to regain the competitive edge in this financial warfare. Whoever moves first wins. Factor 4. The acute debt crisis. By 2027, the crisis of the debt death spiral will be undeniable. At current spending and borrowing trajectories, the federal debt will likely exceed $40 trillion, with annual interest payments approaching $1.5 trillion. The sheer scale of the crisis will provide the political justification needed for the executive order. Trump will not need to manufacture a crisis. The math will have already delivered it, making emergency action politically justifiable to the wider public. Factor 5. Historical century marks. While less rigorous, financial cycles often align with century marks. 2027 is 100 years after the late 1920s bubble peak, which preceded the 1929 crash and the 1933 reset. These chronological anchors often play into the psychology of grand historical decision-making. All evidence points away from a slow evolution and toward a sudden, decisive action. The anchor is set. 2027 is the deadline. Twit ve. Toi se tiptuk wird von ver fantiku the vesu koenjao taisan nai. Part 6. The Great Wealth Transfer. Winners and the 90% losers. 650 words. The monetary reset is fundamentally a wealth transfer mechanism. Every time a currency is devalued, wealth is shifted from the holders of paper assets to the holders of hard assets. When gold is revalued from $2,000 to $20,000 per ounce, someone must win and someone must lose. This reset will create millionaires and billionaires overnight while destroying the retirement plans of tens of millions. The winners, those who hold reality. The winners in the 2027 reset are those who correctly position their wealth outside of the fiat dollar system. Asterisk, physical gold and silver holders. This group wins massively and instantly. When the government announces the new fixed price, whether it is $10,000 or $20,000 per ounce, the nominal value of their physical holdings multiplies by 5 times to 10 times. A person holding 100 ounces of gold, worth approximately $200,000 pre-reset, suddenly possesses an asset worth $2 million post-reset. Note, this assumes the gold is either successfully hidden or held outside of US jurisdiction to avoid potential confiscation or forced sale at pre-reset prices. Asterisk, gold mining companies. These companies see the value of their proven and probable reserves explode overnight. A mine containing 10 million ounces of gold, valued at $20,000 per ounce, suddenly sees its assets jump from $20 billion to $200 billion. Stocks of major miners like Barrick Gold, Newmont, and Franco-Nevada would see their market capitalizations surge, possibly yielding 10 times to 20 times gains. Asterisk, hard asset owners with fixed-rate debt. This is a crucial, often overlooked winner. People who own productive, hard assets such as real estate, farmland, or essential infrastructure businesses benefit because the asset value inflates while the debt value evaporates. If you have a house valued at $500,000 with a fixed-rate mortgage of $300,000 and the dollar is devalued by 90%, the house's nominal value might become $5 million, but your $300,000 mortgage is now equivalent to only $30,000 in real pre-reset purchasing power. The debt is virtually erased. The 90% losers, those who hold promises. The losers are those who trusted the government's promise that paper assets would retain their value. Asterisk, dollar cash holders. Anyone holding cash, checking accounts, or non-interest-bearing savings accounts will lose 90% of their real purchasing power. $1 million in cash immediately becomes worth only $100,000 in terms of goods and services. Asterisk, bondholders and treasury investors. This group is destroyed. US Treasury bonds, corporate bonds, and municipal bonds are all promises to repay dollars. While you are repaid the nominal amount, those dollars are now devalued by 90%. A seemingly safe 10-year Treasury bond paying 4% interest is rendered nearly worthless in real terms. Asterisk, foreign creditors, China, Japan, and other nations holding trillions of dollars in US Treasury bonds as foreign reserves are the primary casualties. They accumulated these reserves through decades of trade surpluses. Their entire US Treasury portfolio, worth approximately $2 trillion, will be reduced to a real value of approximately $200 billion. This is the largest sovereign theft in financial history. Asterisk, pension funds, insurance companies, and retirees. These institutions and individuals rely heavily on holding vast portfolios of high-grade, dollar-denominated bonds to ensure solvency and pay retirement incomes. When those bonds lose 90% of their real value, pension funds become insolvent, and retirees who expected $50,000 per year will find that income buys what $5,000 used to buy. Their savings earned over 40 years are wiped out. The reset is designed to be painless for the government, but catastrophic for the global creditor class and the middle class holding paper wealth. The pattern is clear. The date is set, the mechanism is documented. If the 2027 reset follows the 1933 and 1971 precedents, the time to prepare is now, before the crisis makes action impossible. Once the emergency is declared, the markets will freeze, and it will be too late. These are the strategies based on historical outcomes that worked for those who survived the last 2 monetary resets. Strategy 1. Buy physical gold and secure its custody. Acquire physical gold and silver bullion. This is your primary insurance against dollar devaluation. Historically, those who hid their gold successfully during the 1933 confiscation protected their wealth entirely. Strategy 2. Utilize foreign jurisdiction. If the US government restricts domestic gold ownership, foreign-held gold should be insulated. Buy physical gold and arrange for its storage in allocated, segregated accounts in jurisdictions known for strong property rights such as Switzerland, Singapore, or Liechtenstein. This is a legal, lower-risk way to avoid domestic confiscation risk. Strategy 3. Invest in gold mining equities. Acquire shares in major gold and silver mining companies. These companies benefit instantly from the massive revaluation of gold prices without facing the direct confiscation risk associated with holding physical bullion domestically. Prioritize miners with operations and legal domicile outside of the US. Strategy 4. Acquire hard assets and use fixed-rate leverage. Purchase productive real estate, commercial property, or farmland. The goal is to own assets that retain or increase their value while simultaneously holding long-term, fixed-rate debt denominated in dollars. The 90% devaluation of the dollar makes the debt disappear in real terms, drastically accelerating wealth accumulation. Strategy 5. Diversify away from dollar exposure. Hold a portion of your liquid wealth in currencies backed by economically strong nations with low debt to GDP ratios, such as the Swiss franc or the Norwegian krone. Also, diversify equity holdings into international markets that are not dollar-denominated. Strategy 6. Build resilience reserves. In the short term, the shock of a reset, the potential bank holidays, freezes on trading, and market chaos can disrupt supply chains. Hold physical reserves of food, water, medicine, and fuel sufficient for several weeks to survive any temporary societal disruption that may accompany the financial transformation. The Great Reset is not a theory, it is a historical consequence of unpayable debt. 2027 is the convergence point. The winners will be those who saw the pattern, understood the mechanisms, and positioned their wealth to survive the 90% devaluation. The choice is stark. Trust the failing paper system, or prepare for the sound money reset. The time to decide is running out.